Hey there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and thank you so much for joining me here on my weekly show on StockCharts TV. A little later in the week, we usually put a video out on Monday, but we just got back from a family trip to Ireland, had a great break from the markets, although I did snatch a look or two at the charts while I was there. But great to be back in a sunny and comfortably warm and not too hot Redmond, Washington. Speaking of, not too hot and kind of cooling off, the markets, particularly mega cap growth stocks, starting to struggle here in the month of August. Now, it's not much of a surprise if you know the seasonality, and we've talked in our content recently about the seasonal tendencies in August and September. The S&P usually has a tough stretch right about now this time of year, particularly in a post-election year like 2025. But we're really seeing this week, we're seeing some renewed weakness in some of those leading growth names. These are the names that have been doing the lion's share of the gains in 2025, right? Technology, as we've covered pretty deeply, the strongest sector, not even close in terms of comparing its incredible performance relative to the other 10 S&P sectors. That's really starting to change. So today we're going to talk about three sort of related topics. Number one, that leadership rotation where some of those leading mega cap growth stocks are starting to show signs of weakness. And I'll highlight the three charts I think are most important to watch. Two of them looking quite weak here, and the third not so good either. Second, we'll talk about breadth conditions, because the reality is if those leading growth names struggle, the benchmarks, the major benchmarks like the S&P and the NASDAQ are most likely going to struggle as well. But breadth conditions remaining fairly strong tells you there are opportunities out there. It tells you that plenty of stocks are still doing quite well. So we will leverage the power of the StockCharts scan engine. I'll share with you one of the scans that I run all the time to identify emerging areas of strength and highlight three stocks that came up on that scan when I ran it earlier today. With that in mind, here is our chart of first chart that we'll talk about, looking at Meta, Microsoft, and Apple. Now, this particular chart style, I call it my ABC chart style because it basically allows me to compare three different charts or three different stocks on one page, right? So here I can see the chart of Meta and then Microsoft and Apple, and the chart is sort of evenly distributed with one panel for each of those three charts. I have another chart style that I have a button for because I use it all the time called comparing two stocks, or my AB chart style, where I look at one chart versus another. When you're analyzing individual stocks in ETFs, one of the great benefits of a platform like StockCharts is that it allows you to compare them, right? I found as an equity investor, it's not about analyzing one particular stock like Meta and figuring out the technical configuration and deciding whether it's a buy or sell. I mean, that's part of it. But the more important game is to determine which out of a group of stocks represents the best opportunity. So a lot of times it's not just analyzing Meta, but it's looking at Meta versus Microsoft, or Meta versus Alphabet, or Meta versus Home Depot, right? And figuring out how different stocks and patterns are related to one another. So this is a chart style I use all the time. I would encourage you to have a chart style like this set up on the StockCharts platform. We'll include a link to these two chart styles. You're welcome to save them to your own login. You should all be StockCharts paid members, and if not, this is a good opportunity to do so because you have the ability to manage and use all of these great different chart styles and save them to your own log. And that's where you really benefit from the rich capabilities of a platform like this. So the way that you create a chart like this is you create a chart. So here I'm looking at Meta, and then the magic is in the indicators section. So here I'm using an indicator called price, and then under parameters, you can see I have two parameters indicated. The ticker, so I have Microsoft, comma, LOG for log, and that means I'm showing it on a semi-log scale. All of the charts, almost all the charts that I use a log scale. That's a better way of representing a stock or ETF over an extended period of time because it charts the y-axis on percentage terms instead of on price terms. It's a good way of understanding the percentage swings in a stock or ETF over a period of time. So by adding Meta on log scale and then adding these two other indicators, price with the ticker, comma, log, and I have it as open, high, low, close bars. Sometimes I'll put an overlay and I'll put a simple moving average. Sometimes I don't have them on this particular chart. But that's how I would add it as well. Then I can compare these three different stocks, and all I need to do if I want to, create a different comparison, bring it up on a different stock, and then just change the bottom tickers how I would want it. If I want to add the 50-day moving average, which is what I'm going to do, because a couple of these are actually testing their 50-day, I'm going to add the 50-day moving average there, and here in the indicators section, I'm just going to add an overlay with the simple moving average. So now I can see my chart has the price and then the 50-day moving average. Also the pink horizontal lines, those are lines that I've drawn on the charts here. A couple weeks ago, before I left with my family to Ireland, I shared this chart with my Market Misbehavior Premium members as one of the key charts to follow while I was gone. And my comment was, look, Meta and Microsoft recently gapped higher. This is at the end of July. They both had incredible earnings. I mean, about as good of earnings as you can imagine for these two companies to have. They had it. And toward the end of July, they both reported those earnings. They both gapped higher the morning after their earnings release. But if you look, Microsoft gapped higher, closed lower, and that's literally been the high point for 2025. From there, it's pretty much been in a free fall of sorts, right? Particularly in the last week. Meta actually bounced up to that gap level a couple times, but this week is now rotating back lower, and both of those two charts are now testing the 50-day moving average. If you'll notice, Microsoft is now slightly below its breakout level. This was the all-time high before that earnings release. You can see we gapped above there, bounced off of it a couple times as support, and now this week actually breaking down below that breakout level. So now I think you would label it a failed breakout because it was unable to hold that $520 level. For Meta, you can see it bounced up against resistance in late June. We gapped well above that level, but now we're right back at the breakout point. And for Meta, that's around 725 is that breakout. It's actually a little bit further, right? Isn't it? 725, 750. We'll call it like 730, 735 would be that level. So both of these charts now are threatening to fail and break below the breakout level. Both of them today, here on Wednesday, August 20th, testing the 50-day moving average. And I think if either of those, or if both of those break below the 50-day, that would confirm a bearish rotation for those two stocks. Now, Apple's at the bottom. Apple doesn't look as bad. Now, while Meta and Microsoft gapped higher because of earnings, if you remember earlier this month, Apple gapped higher on the news that they were, investing a ton of money in the U.S. There was a, big headline with Tim Cook at the White House, this big announcement that Apple was, reinvesting in the U.S., and it was a huge deal. So this was less of an earnings related breakout, more of a news-driven breakout. However, the stock continued higher for about a week after that announcement. From there, though, if you look at the last week, every day Apple has closed below the open, which means during the day we've opened and then traded lower. So there's really a lack of accumulation happening with the chart of Apple. So it's well above the breakout level, which is around 215. It's also well above the 50-day moving average, which is currently at $211. But if those levels would fail to hold, I think Apple could be the third of these mega cap growth names starting to struggle. Now, there are others, right? Broadcom has pulled back to the 50-day, and others, pretty much all of that group have broken down. Tesla, which broke out of a coil pattern, is now back within the range of that pattern. So across the board, we've seen weakness. But those are three charts in particular that I'm keeping an eye on. And again, I love this ABC ChartStyle, which allows you to compare and contrast three different stocks and look at them on an apples-to-apples basis. And as I mentioned, we'll include a link, so you're welcome to save that chart to your own StockCharts login. Now, here's the thing, though. While those mega cap growth stocks are starting to struggle, the breadth conditions are actually still pretty favorable. Here's the S&P 500 along with two data series at the bottom. This in blue is the percent of S&P 500 members above their 200-day moving average. At the bottom in green, the percent of stocks above their 50-day moving average. These are two breadth indicators I love to track very, very closely. I think of the stocks above their 200-day as sort of the long-term breadth, right? How many stocks are above that long-term trend-following mechanism? And then in green is more of the short-term version. What percent of the S&P members are above their 50-day moving average, right? Or holding that short-term level of support. So while the S&P 500, the NASDAQ starting to roll over this week, while Meta and Microsoft and other leading growth names are rolling over, this particular chart is still telling you that a lot of stocks are still in good shape, right? And even though some of those names have pulled back, most members of the S&P 500, about 64%, still remain above their 50-day moving average, and 65% remain above their 200-day moving average. So a lot of stocks are not breaking down at this point. It's not like everything's struggling and things look pretty bad. There actually have plenty of charts looking pretty good. And this is what a chart like this breadth indicator, really helps reinforce for me, is when you see some short-term weakness in the major averages, I immediately want to look at breadth indicators like this to see if they are also showing signs of weakness. And if not, that tells me that maybe it's just the leading growth names. Maybe it's just technology and other sectors that have done so well that are starting to struggle. And maybe there are other areas of the market doing quite well at that same point. So breadth overall still pretty good, right? So weakness in mega cap growth, weakness in some of the major averages in terms of short-term pullbacks this week, but breadth conditions still pretty good. Most stocks still holding above key moving average support. So the question then, obviously, I think logically goes, what's working, right? So this is a scan that I run all the time on the StockCharts platform. I call it my new swing highs scan. It looks for new 13-week highs or 3-month highs, right? 65-day highs. You can think of it in any of those different ways. It's about the same. Basically, what this scan does, and going from top to bottom, I'm looking at stocks listed on the major U.S. exchanges. I'm eliminating ETFs in this particular scan, but I actually have this just in case I want to switch and look at ETFs. I can do that easily from this point. I'm looking only for stocks with a market cap above $5 billion, but also in this particular scan, I'm limiting it to the S&P 500 just so we have a working list of stocks that we're all pretty familiar with. Now, all of that is just sort of setting the table. The real guts of the scan are that line number 6, that final line, which basically says the current weekly close. So the close of the current weekly bar is higher than last week's highest 13-week close, right? That was horrible. That was literally a horrible way of saying that. Let me try that again. This current weekly close, if you look at the last 13 weeks, take the highest closing weekly value for the last 13 weeks, and I want to make sure this week we're trading above it. So we are at a new 13-week high, again, using weekly closing data. And you can use weekly highs if you want to do that. You can obviously customize this scan for however makes sense for you. But for me, I look at 13-week closing highs and again, 13-week closing lows as a way of identifying stocks that have really, through the course of this week, able to make progress above or below the range from the last 3 months. Now, I ran that scan a little earlier. It came up with 101 members of the S&P 500. So about 20% of the S&P 500 are making a new 13-week high, closing high this week. So again, while the major mega cap growth stocks are struggling, there are plenty of stocks that are actually holding up quite well, and that's as evidenced by the fact that 20% of the S&P are returned from this scan just today. Now, I hand-selected 3 charts to share with you just as an example of the type of charts that are out there, right? So if you think about the chart of Meta, right, breaking out, pulling back. Look at the chart of Microsoft, gapping higher and failing, testing the 50-day. Compare that to AT&T, which made a new all-time high today on Wednesday, August 20th. So while some areas of the market are certainly struggling, not all areas. And here we can see, looking at AT&T over the last year and a half, that there's an incredible run in 2024, and really Q1 of 2025 was remarkably strong as well. Now, it sold off in early April like everything else did, but because it had done so well in February and March while the major benchmarks were struggling, you can see that the relative performance was actually quite positive during those months. Off of the April low, it did rebound into early May, but that was kind of it. And for May, June, and July, and now the first couple weeks in August, we've really been just trying to get above that peak from early April. As a result, because a lot of other stocks, like those growth names in technology and communication services sectors, have had strong April, May, June, July. That's why AT&T basically being flat means you've been underperforming. But look at how the relative performance just in the last couple weeks starting to turn higher. Look at how the momentum is starting to improve because AT&T is now starting to break out. And I think this push above $29 a share, which is just happening this week, making a new all-time high, finally getting out of that that consolidation phase that we've been in since early April. Now, it's not just about price appreciation. Also remember, with a defensive stock like an AT&T, you also have a decent dividend component, right? So this is currently trading at a dividend yield of around 3.8%. That dividend yield was a lot higher back here because it paid a healthy dividend. The stock was trading at a much lower price. Even with this price appreciation, it still yields way more than the average stock in the S&P 500, and certainly better than the types of names you would see in growth sectors like technology. So AT&T is an example of a stock that has been really more sideways, and while the growth areas of the market have been thriving, AT&T has just been sort of treading water. And now, just in the last couple weeks, in the month of August, AT&T is really starting to emerge in a position of strength. I think that's a great chart, getting greater. Chart number 2 in the consumer discretionary sector, McDonald's. This isn't really the growthy part of consumer discretionary. Those would be things like Amazon or Tesla. This is more of the, more consumer staples types of things, right? Like fast food, retail, restaurant types of names. And I would say what's going for McDonald's is the fact that it has made a new 3-month high. And we can see that by the fact that it's just broken above 310. So it's making a new swing high just this week. The RSI is what immediately drew my attention on this chart because you can see it's just pushing above 60. What happens when a stock is in a bullish phase is the RSI often remains in the upper half and rarely gets below 40 on pullbacks. When a stock really starts to sell off, the entire range of the RSI starts to drift lower. And we saw that most recently in May into June when the RSI finally got below 30. From there, however, the RSI has been right around the 50 level for about a month. And now just this week breaking above 60. The fact that the momentum is improving, the fact that we're making new swing highs on stronger momentum suggests there's a period of accumulation. There's some buying power that's causing the price to push higher. One area of concern for the chart of McDonald's, just the fact that we are bumping up against the highs for the year. So you can see the high from early March got up to around 325. Here in April and May, we hit resistance around 320. That's not too far above current levels. See, we traded up to around 316, 317. So I'd be looking to get a confirmation with a valid breakout above 320, which would clear that resistance level and make a new 52-week closing high. But assuming that happens, I think McDonald's, that is, could be setting up for a nice breakout here. This is the type of chart I probably would be a little more conservative with. This is where I would use the alerts functionality on StockCharts and say, hey, give me an alert when McDonald's breaks above $320 a share. The way you do that, by the way, is just below the sharp chart. There's a little orange bell icon, and if you click on that, it'll automatically bring up the stock McDonald's. We can say break above 320. Add a message, and I say breakout, and make sure I always select all of these. Email site notifications, so it'll pop up with a little banner. It'll email you and it'll text you on your phone. Just on the flight back yesterday, I got a text because one of the intel on the news this week broke out above a resistance level. So I find the alerts functionality absolutely fantastic. This is one of those charts that's probably a little early. I would be patiently waiting for a move above 320 to take any sort of action, but I think that's a clear level to find as you look at the chart. Finally, MasterCard, kind of similar to the chart of McDonald's. I think it's right at that point where it's breaking out. I was looking for a break above 590, which just happened today. So I would love to see if that breakout is confirmed with Thursday and Friday's price action. But I would say similar to the chart of McDonald's, we have the RSI in the last week pushing above 60, which suggests to me we're now in a new accumulation phase. We're starting to see positive momentum. We're starting to see improving relative strength. We have the moving averages in the proper order with the price above the 21-day EMA, which is above the 50-day simple moving average, which is above the 200-day simple moving average. That's a nice moving average configuration. Again, I would love to see a confirmed break above 590 and want to see that held. But given the fact that we're pushing higher on stronger momentum, stronger relative strength, it tells me MasterCard may be a pretty good opportunity here as well. So there you go. That's kind of where I'm at using the, looking at the leadership rotation. I think, this market has run to an incredible degree in April, May, June, July into early August, driven in, almost entirely, one would argue, by the strength in growth sectors like technology. Just in the last couple weeks, we've been seeing plenty of signs to be concerned about, particularly the gap higher in Meta and Microsoft that started to be faded. And as those leading growth stocks are starting to pull back, the question is, where do you go, right? Where are the opportunities? And using the scan engine on the StockCharts platform, I think you have a great opportunity to identify some of those new emerging names and maybe bet on some of those stocks that are really starting to break out of bases as opposed to those that are struggling after having an incredible run to the upside. Which charts are you seeing that are breaking out? Where are you seeing opportunities as some of those leading names like Meta and Microsoft are struggling? Drop a comment below and let me know. I'd love to know what tickers stand out in your work. That'll do it for today. Thanks for watching my show here on StockCharts TV. My name's Dave Keller with Market Misbehavior. I'm taking a bit of a break, by the way, with my market recap show and podcast, but have no fear, they'll be back after Labor Day in early September. In the meantime, have a wonderful August, and I wish you the best. And as a reminder, it's always a good time to own good charts. Take care, folks.